Thank you, Sean. All right. Well, again, welcome everyone to our new episode of Smart Investing. Uh, Tonight, we're going to talk about the Iron Condor, and basically, why we are doing this is because of the choppiness in the markets. We are building on the last 2 weeks. We've talked about straddle, talked about strangle. Both of them are volatility oriented. Basically, there is no bias, so we don't know which direction, or there's no directional bias. So both of them are debit oriented. We don't know if it's going to go down, it's going to go up. So we buy both put and call. With straddle, if you recall, we buy at the money, this one price, strike price, and we buy a put and a call at the same at the money strike price. With the strangle, which we worked on last week, is we basically, it's the same idea, except we are using two strike prices, out of money put and out of money call. Building on that, I thought it's very timely that we talk about something called this iron condor. Tonight, we're going to emphasize on the selling and actually work on how we can receive credit. And uh, again, I've mentioned before, these ideas, strategies you can find in many other YouTubes. You can watch on, um, there's there are shows for that. There are many books written. So my goal is hopefully just briefly talk about the strategy, but then go to the examples and also work on how do we find the candidates, for instance. So um, again, condor, a big bird. Why is it called condor? Is because of those wings that you see. Basically, the strategy works with why is it called condor? Again, the wide wings, because we have, in this situation, even though there's like four legs, we have two calls, two puts, and the reason it's called iron because it has both call and a put. Now, the strategies again we built on. We've talked about spreads. We've talked about straddle, strangle. There's also something called condor, and there's butterfly. Now, when we put iron in front of them, which is iron butterfly and iron condor, that means we use both calls and puts. So a condor by itself, you will use either calls or puts. It's either or. Or with butterflies, it's just by itself, you use either calls or puts. When you do iron, you use both call and the puts. And basically, again, our bias is neutral. We don't know which direction things are happening, but all we know is we like to contain the price within a range. And that's why we use that expected move. We look at the options. We want to see what will happen in a month. And our goal is to see if that price will stay within that range. We can use channels. We can use Bollinger Bands. We can use Keltner channels. But the best one is those expected moves that we've used. One standard deviation contains 68% of the time, two standard deviations 95% of the time. Based on that knowledge, you can set up something called iron condor. Our maximum profit is the credit that we receive by selling it. Our maximum loss will be the spread between the prices that we had chosen. So if there's a $5 spread and we received $1, for instance, our maximum loss will be $4. That's a realized loss. Now, actually, without that credit received, the spread would have been, the $5 would be our maximum loss. Again, I mentioned this is ideal for selling. You can actually buy iron condor, which builds on the strangle that we had talked before, works on volatility. So when you buy iron condor, you actually have to pay a premium, which is a debit. In our situation tonight, I'm going to emphasize on selling iron condor and collecting the premium and working on a neutral bias. Again, because of the election, we do have the volatility, but it looks like we kind of will contain within certain price range. I just using just an example. Let's say you think that S&P 500 will be contained between 3,100 and 3,500. That's your containment, and those are the end wings for you. So you can use a strategy to say, well, I want to have a strategy that I don't have to risk a lot, but I want to make sure I take advantage of the situation and maybe collect premium. Now, what is the anatomy of all this? How do we do this? Is in reality, you're buying a, you're selling a call and buying a higher call or more out of money call to really finance, I mean, in order to hedge your selling the call that you sold. You do the same thing. You sell the put, and and then you buy something lower to make sure you hedge the put that you sold. Remember, when you sell something, you are really exposing yourself to, first of all, for the large margin required, but also if you're selling, let's say, a call, you're basically have unlimited risk. With the selling the put, you can go to zero. That's a lot of risk. By having these spreads, you're really limiting your risk. So in reality, the anatomy of selling an iron condor is you have a bull put spread, you have a bear call spread. When you combine them, you're neutral. You could also say that once you can see the way this looks, in reality, we talked about the strangle, you're actually selling one strangle and then you're buying a wider strangle in that. So lessons that we learned, again, the strangle was buying and selling a call and put with the strike out of money strike price. So you're doing the same thing. You're buying one strangle or selling one strangle and you're buying a wider strangle. So in this situation, these are your boundaries, right? The wings that we talked, and you say, well, this is what I think this stock or the asset, whatever you've chosen, will be around here. And based on that, you're basically collecting the premium. Now, so if it expires, you keep both credits because you've sold the call and sold the put. Now, in order to protect yourself, you go a little outside and buy something to protect yourself to make sure it's hedged. And in this situation, for instance, that's the more out of money protection call and put. So in reality, you sell one out of money put, you buy one further out of the money put, you sell one out of money call and buy one further out of the money call. So basically, this one is a put spread and this one is a call spread. And both of them are credit, except this is bullish call, this is a bearish call. And this is the reason it is called iron condor. You can see it looks like a bird, and these are your wings. And what happened is, again, you decided to short these strike prices, and then basically then you went out and bought a little more out of money, and then basically the maximum loss that you will have is the spread between these and the credit that you receive. So with that in mind, again, you can do that, study a little more about the condors to see. I just want to go to the meat of it and tell you how we can take advantage of them and have the probability in our side. So with condors is the probability game. So the idea is you don't make a lot of money, but you get frequent money. What I mean by that is because the probability is on your side, basically you're assured like 80%, 75, 85% of the time it will be a good call. So you have to do enough. I mentioned you don't make a huge amount of money. It's not, again, directionally biased. So basically what happens is you want to make sure you use the right probabilities, but also you don't want to go so much, like go to 95% probability that you don't really make a lot of money. So that's something we'll talk a little bit later. So in general rules, what I would suggest, you want to make sure you use liquid stocks. For stocks, if I want to use, and you will see that I emphasize more on indexes, but if you want to find some candidates with the stocks, for instance, again, like even the futures, if you have some assets underneath, what you could do, usually you can use 30 to 60 days. That's pretty acceptable. but make sure you use liquid stocks again because of the spread. Now, one thing is, you'll see the example, we can use the delta or the in the money probability. So what you sit down and think about, either you can use the expected move, or you can actually put the option pane and say which call. So we start with the call. We say which one is in the money, the probability of 15% and lower. You choose that one, and then you sell that, and based on that one criteria, you build your whole strategy. If you don't want to use the probability side of things, you can use the delta. Usually about 0.15 delta is pretty good, because you want to make sure, because you're selling, you want to make sure the odds are in your favor. So a low delta, what it means is there's a 15% chance this bet will be in the money. So your goal is to want to make sure that you go as low a delta as possible, but not too low, because you're not going to be collecting that much premium. So you want to make sure it's worth your troubles. Another attractive thing, and it's very important, and that's the reason I'd like you to consider iron condor, and the same thing we will talk on iron butterflies in the future, is when you actually do, let's say you do naked selling, right? What happens is you're required to put a large amount of margins, because you have to cover it. Unless you're in the level 4, then still you will be needed to put 20% margin. Normally, if you're not in up to level 3, then you have to put 100% margin to sell something. Here, the only margin you're required is what is that maximum loss. So I mentioned before, if your spread is $500 and you collected $1, so your maximum in this situation, the difference between the spread and the credit that you have. So based on that, again, let's say you end up with no credits. If the spread is $5, that's $500, right? Each one contract represents 100 shares, and it's like $1. So $5 is 500. Even if you had 5, you're only required to have $2,500 of margin. If it's 10, in this case, it's 5,000. Compare it to if you sold a share of, let's say, Apple, or you sold a share of, sold a put up on Tesla, which had its own earnings today. Now you're talking about just on one contract, you have to put $12,000, $13,000 margin. Okay? So that's attractive things. Now, one of the things I would recommend, the way I use it for iron condors, is because of the earnings with the stocks, sometimes, again, the volatility becomes your enemy. You don't want to have too much volatility. The indexes become more attractive. And when I say indexes, you can actually play the big S&P or SPX. But for you, I think the most attractive way would be the ETFs. And the best ones that I think works the best is the spiders, which is the SPY, the Russell 2000 IWM, and you can also use QQQ. You can do DIA for the Dow Jones Industrial, the Dow Jones 30. You can do IYT XLF, but the main ones I would suggest is the spiders and IWM. And the reason I say that, because you don't have to worry about earnings volatility with them. They are very liquid. They allow you to have a little more predictability than from the micro point of view with the stocks. So you can use both, and in our examples, I've used both, but I think the better outcome would be more with your indexes. So here's my 7 rules or 7 criteria I say for my SPY and IWM iron condors that I recommend for you to consider. Now, the number 1, obviously, because of SPYs, they are liquid, but make sure there's a high open interest, there's a high volume in the front month and at the money. So, and again, that's another reason I use the SPY IWM. So whatever other index that you use, make sure there's a high liquidity. And why is that? Obviously, because of remember, I have that 1 penny rule, 2 penny rule for the spread, because the more money you pay, the market makers, the less profit you will have. So you want to make sure there's liquidity and very low spread. For spiders and IWM, the ideal time is 50 to 90 days. When you go shorter than 3 weeks, unless you really have a defined narrow range and has been happening, and uh, you see the expected move is pretty low, that's a different story. But majority of time, then you have a directional bias, and then gamma becomes your enemy. If you recall 2 weeks ago, we talked about the option Greeks, and we're talking about the delta is going to expand. So you don't want to do that. You want to make sure you keep as much money as possible, because you want to make sure that the price is going to stay within your boundaries. So recommendation is 50 to 90 days. 60 days is pretty attractive. So that's where I will start. And then usually that's what you want to keep it, and do it for maybe 30 or 40 days and exit it at that time. So you hold it for, if it's 50 days, by the time it gets to 30 and 20, although the theta is a decade, but the volatility could be expanding. So the ideal time will be to get by at 50 to 90 days. Now, when you want to choose which, okay, you decided the expiration date, and then the delta, you can go as low as 0.06 to 10. That means there's like a 90% chance that this is going to expire worthless, that the sell side. So you choose the call. So you always start with the call data, delta, the call that you're going to sell, and everything else gets built on that. And you will see an example how that works. Now, once you got that delta, you can go use the spread. For instance, if you got a $300, let's say we put $340 spider, then you can say, well, I'm going to go and buy 342 or 343 or 345. Usually $2 to $5 spread is pretty good. When you go to $10, now we are really expanding our risk, because remember, the spread is your maximum loss. So, but there are times it can actually go $50. As long as your risk is under control, you can do whatever you want. But the $5 I found is a sweet spot. Now, if you are really want to be neutral, what you want to do, use the same distance for call and put. And what I mean by that is, if you chose, let's say you chose today the spiders at 330, you chose 340 and 345, for instance, for the call side. Now, that's $10 more than 330. Then you want to go to 320 put and 315 put. But that doesn't necessarily that you don't have to do it that way, because I will show you an example that you can actually play based on the in the money probability and using the deltas to set up your strategy. So it doesn't have to be exactly, like we did in Strangle. This is basically based on probability. So hopefully the examples will help you to understand it. But if you really wanted to have the same thing, the same distance, then for the absolute neutrality, then you're you're welcome to choose the same distance. As far as purchasing it, now let's say when you put the limit order, make sure you use the mid price range. So don't, although again, depends on, when I do the directional bias, let's say if I want to buy calls on spiders, there's only 1 penny, 2 penny. I'm not bothered with that. I'm willing to buy in the market because I'm pretty sure, I've done my analysis. But when you do have, especially now we have 4 legs, remember we have a call, we have a put, we have another call, we have another put. So when you have 4, there's a lot of spread. So what you want to do, you want to put the mid ask and bid price to buy. So you always put a limit. You already know how much it is. Now, if after 30 or 40 minutes you are not filled, cancel it, take a look at it again. Would you agree with that analysis? Then put another mid price until you get filled. it's the beauty of this is when we use the indexes, you can always continue, um, day after day, because your analysis is based on, again, you look at the standard deviation, or you look at the channel. So you can review that every day if you want. But if you missed it, so be it. You can try it again. Now, the exit will be if you are, let's say, remember, we started with 0.06 to 10. Now the volatility is kicking in. Let's say now the things are going against you. Now the delta, because of the volatility, is expanding. So all of a sudden, remember, the delta pushes actually the prices up. That's what we talked about gamma. So the delta is now, if it's going over 0.35, that's time to take your losses and leave. If your short put side is over 0.45, it's time to leave. The other exit strategy will be if your risk is 3 times more than your credit at the time. So for instance, you analyzed it and said, well, this was a good idea. I had like for $1 credit, I have $2 risk. But as the time goes by, you see that, okay, now the risk is, as it's getting closer to expiration, the risk is getting higher and higher, then I would not let go beyond the 3 times your credit. So for instance, if you received $1, then if your risk is more than $3, then I will get out. If you receive $2, if your risk is over $6, you want to get out. No questions asked. Although for instance, your maximum risk is, let's say, $8 or $10 or whatever it is, or you want to just hold on to whatever you have at that time and just close your position. Um, as far as the capital allocation, make sure the size that you choose, even though this is kind of a very conservative strategy, but still think of it that there's a chance of 100% of loss. And you make sure you put the amount that you're comfortable losing 100% of it. Although I talked about exit strategy, but let's say things happen operationally, things happen to you. So let's close it. If it's not, make sure the money that you're going to lose, you're okay with it. The other thing with the capital allocation, the beauty of these with iron condors, and you should do that with your other strategies too, is try to diversify. So for instance, your capital allows you to have 10 contracts. I just use that as an example. So maybe you can use 3 or 4 contracts for one strategy for the next 50 days or 60 days. And then I will buy another one for maybe for 90 days. And I keep going. And then maybe I use a different bracket. So you could have a little narrower, a little wider. So basically, by doing this, you're spreading your your capital in a sense that it allows you to take less hit and more control of your portfolio. With that in mind, I think it would be a good idea to just give you one example, for instance, just for a simple stock. Let's say we chose, I chose Micron, for instance. So let's say we are looking at Micron. We feel that in this situation I mentioned, it's a good idea, 30 to 60 days. We chose in this situation December, in this December monthly option expiration, it's about 60 days. And based on that, what we are looking at is we can see that the odds of the expected move is 7.7. It's at $53.40. So let's say about $61. So about 68% of the time, it's going to move either between $61 and maybe $45 to $46. But the criteria that I want to go one beyond that, I mentioned about the delta or probably in the money. So basically, if you can see it probably in the money, that if you have Thinkorswim, this is from TradeStation, it will tell you. What that means is, what is the odds of this option being in the money at the time of expiration, which is in December. Now, I go and I say, well, I think, yeah, 15% is, 16% is a pretty good number. And based on that, I choose a 62.5. So the first thing we do, we choose the call that we want to sell. So far, two criteria is looking okay for us. Number one, we see that the 62.5 is above and beyond our expected move. So that's pretty good. So the odds are in our favor. We also look at about 16% is, we talked about 15% maybe. That's close enough. Also, we're looking at the delta, and the delta is at 21. Yeah, it's not 15, but it's close enough because I want to collect enough premium. Now, the second part is, now I say the next spread, I can go $5. I can go, in this case, it goes 2.5 at a time. Well, I'll choose 2.5. I don't want to take a lot of risk. I just want to take a little bit of risk. Just give you an idea. You can choose, and that's the beauty of this. You can actually, once I will show you how, when you put the trade in, you can just change all these numbers. But then first number, anything you do is first selling the call that you have chosen. Based on that, you can choose your put. As I mentioned, it doesn't have to be equidistance if you don't want to. It's usually very naturally biased. I will go and look at, what is the odds on this? So this 45 put is about, okay, under 20%, 19%. That's pretty good odds. Let me actually go to the next, this one. So this was for the call, so it's a little larger, so hopefully it's a little easier to see. So here's my put. So I have 19% probability, it's under 20%. And also my delta is -15. That's shows again the probability of being in the money. So based on that, then I go to the 2.5 spread. So I sell this put. So again, here we have a bullish put spread. I'm selling the 45 and collecting the 70 cents. And then again, this is just an example. You can see there's a big spread. So, but it is just an idea to tell you that how you will choose your candidate. So in this, or how do you do the trading? So let's say you came out with the, I go back to this, let's go back to this. So again, I started with what is the low in the money probability, what is the low delta. That was my foundation. Based on that, I built everything else. I could have gone up, I could have gone down. It's all up to you how much premium you want to collect. The idea is for every the probability, the less the higher the probability be on your side, that means the less money you will collect. So just make that, keep that in mind. So, and this was my other criteria. Now, basically based on that, let's say, again, this is not the most liquid stock, but it's interesting. So I just want to show you the idea. Based on that, I build it. And here you go and you say, okay, I'm going to sell the 45 put. So, okay, here it is. I did the iron Condor. It comes out its own things. Here is like iron Condor. You just pick that. And then when you get here, you just basically change all those numbers to what you feel is the correct one. And in this situation, you see that you will be collecting about $82 of credit, and basically your maximum loss is $188, which is almost 1 to 2, which is not bad at all. Because again, the odds to be on your side is pretty good, because you could see the probabilities are under 20%. So this is how, and then if I press yes, then my iron Condor is at works. One word of caution is very, very important. Remember, you have 4 legs. Don't ever move out of legs with iron Condors. The idea is you go all in and you go all out. So your exit strategy should be, again, one trade. You go one trade in and you take one trade out. Okay, that's very important. So this is one as far as the stocks go, which we could use again 30/60. So I decided let's do one with Spider. This is just today's close, and I just decided to look at the Spider where it is. And again, with the Spider, as I mentioned to you, I look at very low delta, and I like to have a high interest, open interest, which it has. You want to go out of money, and basically in this case, I chose a delta 10. You could choose delta 9, and basically what I did in this situation, let me just enlarge it. So in this situation, as you can see, could use a 379 and 384. So in this situation, I will collect 118 and I will pay 83 cents debit. So this is one leg up, or the one vertical spread. And then based on that, I could choose the put side, and I could go equidistance. And again, make sure that delta is being probability in the money is low, the delta is low. And basically that's for the as far as the spiders go. Okay, so with the interest of time, one thing is now, again, you can use indexes, you really have to be on your toes. You got to look at again, the charts, you look at the Kirtner channels, you look at the Bollinger Bands, you look at the squeeze, you can do channels, you can do the expected move. So they're pretty liquid. But Thinkorswim has and a screen for we call it the spread book. So what you do, I just thought to share this if you have not used it. These are the criteria that I would use if I wanna every night. I look for some candidates for my option strategies, and what I do, I chose this. Again, you can choose your own basically, but these are the 4 criteria that I use. Basically, I like to make sure that there's it's a good price, stock price. So I don't want to go $10 stock. So you can choose 25, you can use a $50 stock. You don't have to put the maximum. So I go with the minimum of $25 stock. Then as far as the probability, for instance, I chose 70, 80% you can choose. I went with 70 because it's one standard deviation, 68%. You could use that. That means that 30% probability of being in the money when it expires. So I use the 75 and I use 85, the high, because if I go to 95, which is 2 standard deviation, you really do not collect a lot of premium. So basically what happens is you want to keep it narrow between 70 and 85. You could do maybe 90, but these are the candidates. So it's a high probability, but not so high that you end up really not meeting the, making any money for the time that you're spending. Now I look at the profitability of the margins. For instance, I like to go with the 25 minimum percent as far as the profitability goes. That means 1 to 4. So I want to make sure, at least if there's a $5 spread, for instance, if I'm risking 4, at least I'm going to make 1. So you can make 40. You can do, this is, again, it's up to you. The higher this is, again, the less of a chance. So you want to make sure it is within your probabilities. The last but not least is you mentioned the days to expiration. You could use 60. You can use 90. I use the minimum of 30, and I use 60 because I want to see the stocks. I didn't put the could be ETFs. You can put 90 here. So based on all that, these are the candidates came out, and there was this came out. This is from last night, and so it tells you gives you exactly what you should do as far as to have the best results, and the probability of success is 84.5%, and it tells you again what is your maximum loss, what is your maximum gain. This is just an idea for you to pursue more. You can see there's a lot of diagonal, there's vertical, so you can choose that. the next one is, so let's say you decided to do that iron condor. So here we are. This is, I'm sorry, just get the other one. So this is the iron condor we decided to choose, and it tells you what you sold, the call, sold, the put, the spread. And what happens is, as if you do the, oops, if you click the right um, mouse, I mean the right side of the mouse, immediately takes you to this, and all you have to do is, so now you have the candidates, all you do is says create duplicate order. As soon as you press that, it takes you to the order, so you don't have to type anything, any of these, it's already there. It tells you what is the, what is the credit, and based on that, you can just either accept it or not, or you can put your limits and everything. So it makes it a lot easier. So with that in mind, I think we are pretty much in time, and I'll Sean, we can stop the recording, and we can restart for the questionings if anyone has any questions.